Dawn of terror. Stocks in free fall. Chaos ensued at dawn, leaving the financial world on high alert. When Asian markets opened, panic quickly took hold. Japan's Nikkei index plunged in a precipitous fall that brought back grim memories of the 1987 crisis, one of the most critical moments in global economic history. The situation was so dramatic that there was the activation of the circuit breaker, a rare mechanism that interrupts negotiations to prevent even greater collapses. This sudden movement generated a wave of uncertainty that quickly spread through global markets, bringing to the fore the fear of a new economic collapse. The magnitude of this drop cannot be underestimated, especially considering the psychological impact on investors. Japan, one of the world's largest economies, saw its main index suffer significant losses within hours. This wasn't just a simple market correction. It was an alarming sign that something much bigger was afoot. The Nikkei's fall was driven by a combination of factors, including concerns about global economic growth, political instability in Asia, and fears of new waves of financial crisis. This volatile environment created the perfect scenario for a spiral of panic, affecting both institutional investors and retail traders who saw their portfolios melt in a matter of minutes. The impact of this dawn of terror was not restricted to Japan. The repercussions were felt in all financial markets around the world. With Japan paving the way for panic, European and American stock markets began to record considerable losses. The feeling of fear spread, fueled by rumors and speculation about possible bankruptcies, economic downturns, and banking crises. That was just the start of a day that promised to be one of the most chaotic in recent financial market history, with investors scrambling to protect their assets and minimize losses in an environment that seemed out of control. S&P 500 sinking. Brace for impact. The collapse of the S&P 500 the next morning was a devastating blow to global markets. As one of the most important indices in the world, the S&P 500 serves as a bellwether for the health of the American economy and, by extension, the global economy. When this index starts to plummet, the warning signs are clear. Something is very wrong. The decline was rapid and relentless, with the main sectors of the economy, technology, finance, and energy, recording significant losses. This move was not a simple market fluctuation, but rather an indication that economic expectations were changing drastically for the worse. Investors found themselves caught in a perfect storm of bad news. Pessimistic reports on the labor market, coupled with concerns about economic growth and political uncertainty, created an atmosphere of fear that was impossible to ignore. As the S&P 500 tanked, the domino effect began to spread to other global indices. Stocks that were once seen as safe began to fall, dragging investor confidence with it. That collapse has triggered a frantic rush to sell, with many seeking to liquidate their assets in an attempt to avoid even greater losses. Volatility has increased to alarming levels, with daily swings that have left even the most seasoned traders on the verge of nervous breakdown. The impact of this drop was not limited to the stock markets. Consumer and business confidence has also been shaken, with many beginning to question the stability of the global economy. Institutional investors, who typically serve as market stabilizers, have also begun to pull back, pulling large amounts of capital out of the markets and further contributing to the collapse. The panic was exacerbated by the lack of clear answers from economic leaders, who seemed as surprised as anyone by the speed and gravity of the situation. The S&P 500, normally a bastion of stability, became the epicenter of a crisis that promised to have far-reaching repercussions around the world. First trigger: U.S. jobs plummet. The release of U.S. labor market figures the previous week was the first sign that the U.S. economy was in trouble. Job creation in July was far below expectations, a clear indicator that the engine of the global economy was starting to choke. This news fell like a bomb on the markets, generating a ripple effect of uncertainty and fear. The slowdown in job creation suggested the U.S. economy was losing steam, fueling speculation that a recession was looming. This was the first trigger that triggered a series of events that would eventually lead the global market into chaos. The U.S. economy is often compared to one of the turbines that keeps the global economy's plane in the air. When that turbine starts to fail, the whole world feels the impact. The drop in job creation wasn't just bad news for American workers. It was a sign that consumption, production, and investment, the pillars of the economy, were weakening. The market's immediate reaction was panic, with investors rushing to sell assets they considered risky. Uncertainty about the country's economic future has led to a significant pullback in markets, with confidence indices falling sharply. This drop in jobs has also brought to light a number of concerns about U.S. monetary policy. With the labor market weakening, many began to question whether the Federal Reserve would have to step in with more aggressive stimulus measures to avoid a recession. Fears of late or insufficient intervention have contributed to volatility in markets, with investors trying to anticipate the central bank's next moves. This combination of economic uncertainty and political speculation has created an environment of extreme volatility, where any negative news could trigger a new wave of selling and further deepen the crisis. Second trigger: Buffett sells Apple stock. Warren Buffett's decision to sell nearly half of his stake in Apple was the second major shock to global markets. Buffett, widely regarded as one of the wisest and most successful investors in the world, rarely makes such drastic moves without good reason. The news that he was liquidating a significant portion of his Apple shares took the market by surprise, raising questions about the stability of the company and, by extension, the tech sector as a whole. Apple, one of the largest and most valuable companies in the world, has always been seen as a safe haven for investors, and Buffett's decision to sell his shares sparked immediate panic. The market reaction was swift and fierce. Apple's shares began to fall, dragging with it other tech giants that also saw their valuations plummet. This move not only impacted the market value of these companies, but also shook investor confidence in the entire technology sector, which until then had been one of the main drivers of global economic growth. Buffett's sale was seen by many as a warning sign, indicating that perhaps the tech market was overvalued and that a significant correction was imminent. Fears of a collapse in the tech sector have led to a wave of selling in other assets, further exacerbating the crisis. In addition, Buffett's sale of Apple shares raised questions about the company's future prospects. Apple, which has been a pillar of stability and innovation, was now under intense scrutiny. Buffett's decision cast a shadow of doubt on the company's ability to continue leading the market in an increasingly challenging economic environment. Analysts began to reassess their forecasts, and many investors chose to follow Buffett's lead by liquidating their positions before prices fell further. This movement created a downward spiral in the market, where the sale of shares further fueled the fall in prices, generating a cycle of panic and uncertainty. Conflicts in the Middle East, oil at risk. As if the global scenario were not already tense enough, the threat of a new conflict in the Middle East added more fuel to the fire. Israel is preparing for an imminent attack from Iran, which promises to be far more devastating than previous conflicts. This potential conflict is not just a matter of regional security. It has the potential to completely destabilize the global energy market. The Strait of Hormuz, through which a significant portion of the world's oil passes, could become a battleground, disrupting oil supplies and sending oil prices soaring. This prospect is frightening, not just for financial markets, but for the global economy as a whole. Oil is the lifeblood of the global economy, and any disruption to its supply could have catastrophic consequences. If Iran and Israel do clash, the impact on the oil market would be immediate and devastating. With global supply reduced, oil prices could skyrocket, fueling inflation around the world and driving up costs. Energy for consumers and businesses. This situation would create a vicious cycle, where rising oil prices would lead to an economic slowdown, which in turn would put further pressure on financial markets. Fear of this catastrophic scenario is already causing panic among investors, who are rushing to protect themselves from potential losses. In addition to the economic impact, the escalation of tensions in the Middle East also has profound geopolitical implications. A conflict between Israel and Iran could drag down other regional and global powers, creating a situation of instability that would be difficult to control. The United States, Israel's traditional ally, would likely be pulled into the conflict, which could further complicate the already complex situation in the Middle East. Uncertainty about the outcome of this potential conflict is contributing to volatility in the markets. with investors trying to anticipate the potential impacts and adjusting their investment strategies in an increasingly unpredictable environment. Cryptocurrencies collapsing. Bitcoin in free fall. In the midst of all this turmoil, the cryptocurrency market has not been spared either. Bitcoin, the world's largest and best-known cryptocurrency, went into freefall, quickly losing its $50,000 support overnight. This drop was a severe blow to investors who, in previous weeks, had been celebrating Bitcoin's approach to its all-time high. The extreme volatility of cryptocurrencies, already known to all, was exacerbated by global uncertainties, creating a panicked environment where many investors rushed to liquidate their positions. Bitcoin's fall was accompanied by a cascade of losses in other cryptocurrencies, such as Ethereum, which also saw its value plummet. This brutal drop in the crypto market was driven by a combination of factors, including growing distrust about global economic stability and the actions of large institutional investors who have begun to dump their digital assets. The cryptocurrency market, which had been a haven for many investors during the first few months of 2024, suddenly became a minefield. Bitcoin's fall wasn't just a technical correction. It was a sign that confidence in this highly speculative market was beginning to unravel. Many small investors, who had entered the market in search of quick returns, now found themselves in a difficult position, with significant losses and few exit options. The reaction to this drop was mixed. While some analysts saw this as an opportunity to buy on dips, others warned that the worst was yet to come. Robert Kiyosaki, famous for his crisis predictions, appeared again to say that this was the time for the brave to become rich, while the cowards would become poor. However, Kiyosaki's advice, while optimistic, was not enough to calm the nerves of investors who were seeing their portfolios dwindle rapidly. Crypto volatility, while ever present, seemed to be reaching new heights, making even the most seasoned investors nervous about what the future held for the digital asset market. Faced with this chaotic scenario, the question on everyone's mind is, what to do now? The first and most important thing is to stay calm and follow a well-defined strategy. In the midst of panic, it's easy to make hasty decisions that can end up costing you dearly in the long run. Investing in times of crisis requires nerves of steel and a clear vision of long-term goals. This is not the time to despair, but rather to carefully analyze the opportunities that the market may offer. The focus should be on preserving capital and looking for quality assets that can appreciate in value when the dust settles. In addition, it is essential to avoid the risk of ruin. Many investors, especially newbies, risk losing everything by betting on highly speculative assets that promise quick returns, but also carry with them enormous risk. Diversifying the portfolio, investing in assets that offer a good risk-return ratio, and maintaining an emergency reserve are essential practices in times of crisis. Volatility can create opportunities, but it can also destroy fortunes if not managed carefully. It is crucial to avoid panic and maintain a disciplined and strategic approach towards investments. Finally, for those who are interested in expanding their investment options, this may be the time to consider the international market. Opening an international account, such as the one offered by Nomad, can provide access to a wider range of investment opportunities and help mitigate the risks associated with domestic volatility. Taking advantage of market conditions to explore new horizons is a smart strategy, especially when local markets are in turmoil. With the right tools and a well-crafted strategy, it is possible to not only survive this crisis, but to emerge from it in an even stronger position.